In this video, we'll focus on analyzing Fed pivots, which occur when the Federal Reserve cuts interest rates. This is a crucial development for various financial markets, including the stock market, bond market, housing market, and interest rates on credit cards and auto loans. When the Fed pivots, it means they have made a U-turn on monetary policy. The current stage is the first stage, and the Federal Reserve was raising interest rates by 75 basis points at each of their meetings. However, they slowed it down to 50 basis points on December 14th, and further to 25 basis points at their most recent meeting on February 1st. They have also signaled 2 more interest rate increases of 25 basis points each on March 22nd and May 3rd. But many investors do not believe the Fed and expect the March 22nd increase to be the last one. The Federal Reserve is planning to raise interest rates up to 5.25%, and after that, the next stage of the Fed pivot will begin, and the Federal Reserve will pause interest rates at that level, with no more rate increases or cuts. In stage 3 of the Fed pivot, the Federal Reserve will start to cut interest rates, which the market expects to happen on either September 20th, November 1st, or December 13th. However, the Federal Reserve is saying that they will not cut interest rates in 2023. Both sides of the argument are presented, and it is up to you to decide which one you agree with. The real estate market has already been impacted, with the effects more apparent because of its sensitivity to interest rates. The damage will be slower to emerge in other sectors due to the lagging effect, but it will eventually become more visible in the broader economy this year. The expected results are layoffs, bankruptcies, higher unemployment, and a slowdown in GDP growth. Proponents of this argument believe that the Federal Reserve will come to the rescue and start cutting interest rates in 2023 as the economy weakens, which would lead to a reduction in inflation and allow the Federal Reserve to take credit for it. According to the Federal Reserve, the current labor market is tight, but they hope that companies will not resort to layoffs and instead will reduce job openings. They believe that the strength of the labor market will prevent a recession, and therefore no interest rate cuts will be necessary in 2023. Although the economy will experience slower growth below trend, the Fed predicts that positive GDP will be maintained without a recession. Meanwhile, inflation is expected to fall to 3% by the end of this year and 2% by the end of next year. However, the market is divided with loose financial conditions and a risk-on environment, leading many to believe that the worst is behind us and a new bull market has started in stocks and cryptocurrencies. Despite this, I don't think inflation will be easily resolved. To put it simply, the markets are currently euphoric due to the rapid decrease in inflation. Inflation has gone down from 9.1% in June to 6.5% in December, which is about 50 basis points each month. At this pace, inflation will reach 2% in about 10 months, which is a cause for celebration. However, the question remains, what will happen when inflation starts coming down at a much slower pace, such as 30 or 20 basis points per month? The market would likely react with panic. When inflation is high, it's easier to get bigger drops at first, but it becomes increasingly more difficult to reduce it further, similar to losing weight. What if inflation starts trending up again, similar to its historical precedent? Throughout history, inflation has never subsided within a few months of the Fed raising interest rates, but fluctuate between lower highs and lower lows. My opinion is that inflation will fluctuate but remain high in 2023. The easy targets such as energy and goods inflation have already been tackled, and service inflation, excluding housing, is still high, and the labor market is tight. Moreover, energy and commodity prices are rising. Although the stock market is currently in a bull market, it is probably just a bear market rally, and has about 3 dead cat bounces in the past 11 months. It won't be easy to control inflation, nor that the stock market will have a soft landing. When you examine the 1, 2, and 5-year charts, it's clear that the economy is in trouble. The future looks bleak with the potential for interest rate cuts in 2023 due to a crisis in the economy. This will result in a negative impact on the stock market and cryptocurrencies. Alternatively, if inflation becomes more challenging to control, the Federal Reserve will not cut interest rates in 2023, leading to a sluggish economy with high interest rates and no increase in corporate profits. In this situation, growth stocks will suffer. While there won't be a Fed pivot for the next 12 to 15 months, quantitative tightening will grind down financial and stock markets during that time. So, it's wise not to fight the Fed. They have significant control over the stock and bond markets through their ability to print money. It's not advisable to go against the Fed, whether they tighten or ease monetary policy. The overall outlook seems bleak with a potential decline. A reliable benchmark for this is the S&P 500 index. While it is possible to retrace to 3,600, but I may be wrong. It's possible that the US economy could withstand higher interest rates in 2023. Unemployment rates could stay stable, corporate profits could remain strong, and demand could stay robust despite the pandemic, leading to a potential avoidance of a recession. If such a scenario plays out, inflation could drop significantly due to productivity gains, possibly resulting from AI or other technologies. Be sure to subscribe, and thanks for watching.